here with another live video titled, Here's How Disney is Manipulating Its Numbers. Just got a really close look at everything. They came out yesterday. If you want to look at the stock with Disney, it's only trading up 1.6%. We're doing this about 2 p.m. And if you notice, it was a lot higher. And even yesterday it was higher than this. It was, open at 139. I think it was 144, 145, up like 6, 7%. Now it's come down. You know why it's come down? Because people are starting to really look at these numbers. And I want to show them to you. It's very, very important because I see so many bulls on this. And every analyst upgraded the stock. Well, either upgraded the stock or raised that price target. But let's break down numbers and look under the hood. I just want to expand this. To be fair, I haven't been the most right person on Disney, so maybe you should do exactly opposite what I'm telling you. But eventually the numbers do matter, and they're going to matter for Disney. I think this company is a load of trouble, and no one's really talking about it. So let's break it down. So when we look at a recent report from Goldman Sachs right here, right? So they raised their price target. Everything's great. Disney Plus subs came in 73 million right here, right? Higher than the 66 million estimate, right? So that's why the stock's going higher. Disney knows that that number has to go higher because every other part of its business is terrible. That's why they went all in and said a couple months ago, we're going all in on streaming because they know they can add numbers in this segment. And how they're adding numbers, that's what we have to look at. Because the whole entire reason the stock was up and it's coming down is because of this number. Everyone's excited about this. They don't understand this business, I think. And let me explain it. Because when you come down here and you look at Disney, let's look at how they're adding these numbers, right? So this is direct-to-consumer segment. This is the streaming segment. 73 million. Average revenue per user. That's a very big number, right? A very important number in many subscription services. It's only $4.52. To put that in perspective, you're looking at Netflix is over $13, right? So you're saying, hey, they added all these subscribers, Disney plus Hotstar, so it's Disney plus Hotstar, that's their international operation, which accounts for a quarter of Disney's overall subscribers now. So, they're launching India in April, Indonesia, so they're adding subscribers, which contributed 10.5 million of the 16.2 million. So if you take out that 10.5 million from here, you're looking at 63 million, which is less than the estimates, right? And if they would have reported that, the stock would have got crushed. So how did they report all these subscribers? Well, they're international subscribers, right? So if we're looking here, this is last quarter, 57.5 million, jumped up to, everyone's focusing on 73.7 million. No one's asking how they added that many subscribers. Well, Disney Plus did well. That kind of did what was in line with people expected. But look at the international, right? Why is this a big deal? Because when you're looking at the Disney Plus subscribers here, this is important, guys. $5.30. That's how much. That's the average revenue per user. Look at what people are paying. $1.62. So basically, Disney made sure that it could pad its numbers. Again, legally manipulating. It's not illegal to do this, but Disney, it's just so out there in the open. I'm surprised no one's talking about it. But here's the easiest way to add a lot of subscribers. Hey, you know what? We're only going to charge $1.62 to you guys. Of course they're going to come on. So now we're looking at what? Let's look at the Verizon, right? Verizon signed a deal with Disney and said that anyone with their, unlimited package will get a year for free, right? So it's interesting. They got a year for free, and that's right here, 1 year anniversary. Nobody really talked about this, right? But look what Disney did. There should be some churn, which people are going to drop off their file because they got it for free, don't feel like paying. It's normal. There was no churn there. You know why? Because Disney and Verizon, Disney announced that, hey, you know what? You're going to see, if you have the unlimited, the high-tier unlimited plan, you're going to receive free access to the Disney bundle for as long as they remain on that plan. Why is Disney doing that? Because they can't see a drop in that numbers or the stock will get destroyed. So they're like, no, don't worry about the Verizon. Let's give it to them for free. That's why you're seeing the average revenue per user lower. Let's dig in a little further. Because when I'm looking at this, media networks, big trouble there, we all know. I mean, ESPN, they laid off 10% of their staff. They did do okay in this division, but still, you're seeing all this impact from COVID. Studio entertainment impact from COVID. People are changing their habits. Interest in Milan, right? They were going to change the face of streaming, even though they just got into it. They're going to change it by offering $29.99. Notice how they didn't say anything about it? They're still providing a little disclosure because they did terrible, okay? Capital allocation, top priority, right? But when you're looking at these numbers, I mean, this is the direct-to-consumer segment here. Look at the loss. $866 million. Look at next year. I mean, this is forward, $2 billion. If you're looking at the analyst estimates here, this is what I want you to focus on because we're looking at a company where, and this is the important line right here, earnings per share gap, right? So 2018, 730, 2019, 626. Notice how it came down because they're getting into streaming, which is a highly capital-intense business. 2020 throw out, COVID, okay. Now, most companies are saying, hey, we're not going to return to growth. Some of them maybe 2021, maybe 2022, a lot of them. Disney reported $6.26 in 2019. This is the analyst estimates that are raising their target price on the stock right now. 2021, $1.63, $4.53, $5.6, $6.46. They don't expect them to generate what they generated pre-COVID until 2024. Yet they're all raising their target prices on this. And the funny thing here is when you look at capital expenditures, $4 billion, look how it's going up because streaming costs a lot of money. They think they have them estimated $3 billion, $4 billion, $5 billion, $5 billion. I mean, the capital expenditures, that's for the whole business, but you have to look at Netflix. Netflix are going to spend $17 billion alone this year pre-COVID on new content. Now, who is Disney going to be fighting with in this industry that everybody thinks is unlimited growth? You got Apple, $200 billion in cash. AT&T generates $30 billion in free cash flow every single year. You're looking at Amazon, right? Look at their balance sheet. And Netflix. And it's important because you need the best actors and actresses to, for your streaming it. And streaming is all about new content, okay? When you sit down with your wife, sit down with your husband, you don't say, hey, let's put on Netflix and watch a movie from 10 years ago. You want to see the latest thing that came out. So it's a hugely capital-intense business, highly competitive. Their numbers are much lower than anyone. And then when you go to the valuation real quick here, I'm going to break this down for you. All right, here's Disney's forward PE, right? This is the forward PE. Now, it's really crazy high. This is like, now after they get past the COVID part, it came down because now that, okay, you're going to get to earnings in the future, right? Okay, that's fine. So now, but even here at this number, it's trading at 52 times forward earnings. Well, if we look at the 10-year average on this company, it's 23, right? Why does this company deserve? You could say, well, you have Netflix, you could have all these companies like Tesla, Peloton. There's one thing they all have in common. They're growing like a weed. That's why they command that high valuation. Why is Disney commanding a high valuation when their earnings are not going to get back to normal for 4 to 5 years? Right? So you have to be very, very careful here. Listen, if things were good at Disney, they wouldn't have laid off 28,000 employees. They just laid off 10% of ESPN, and they just suspended their dividend. This is the first time I've been doing this for 25 years. I saw a Dow component suspend their dividend, and it's not even like a footnote. Nobody's talking about it. They're suspending their dividend because they can't afford to pay it. So there's a lot going on under the hood here. They're reporting things that people want to see. Don't get caught up with it. This company does not deserve the valuation. Numbers will eventually matter. Could I be wrong? Of course, this thing could really take off and go a lot higher, disregarding every kind of valuation. But the numbers that they're adding, they know Wall Street wants to see it. And the reason why Wall Street is upgrading the stock and doing all this because they know that Disney is going to have to raise a shitload of capital going forward. And a lot of those guys generate a lot of money on those investment fees. I'm Frank Curzio. As always, I'll report back to you guys soon. Take care.